Can U.S. healthcare handle another peak COVID surge? We're going to get the answer to that and other economic questions now with our chief equity strategist and economist, John Blank. John, I know you've done research on this. What did you come up with?
I think the answer is simple, Terry. Yes, we can survive the peak COVID surge. We are basically in it right now for the next 2 weeks. This is January the 27th. Through February the 14th, this is the peak COVID surge. And I do think people need to really be thankful for the work that's going on, particularly with the nursing in the hospitals. And we really need to be thankful for them stepping up their hours. Their stress levels are unbelievable.
You wrote recently that elevated core consumer price inflation and the COVID pandemic go hand in hand. In which way?
It's simple, Terry. It's supply and demand. I mean, you shut down economies that reduce supply, and then you shut in consumers so they went online and got goods production because they couldn't get to services. And you stimulated their spending more by providing them stimulus payments. So everywhere in the world, you see that the same pattern, that the governments shut down supply and consumers increased demand, and that raised consumer prices.
What about the impact on the labor force?
The labor force everywhere is still struggling to get participation rates back up because of the same different COVID effects. Basically, when you have schools shutting down, women had to keep home with their children. Those that could remote work did so, got stressed. Others are unable to return to physical workforces, and that's largely what's keeping the participation rates down.
Let's look at the big economic picture here. First, what is GDP growth looking like for this year?
Well, we get the GDP report for last year just to make this in perspective. It was the best year since 1984, and it's 5.5% year-on-year growth rate. I think you're looking at 3 to 3.5% for 2022.
And is that growth going to be impacted by pandemic?
The pandemic is going to become, in my father, who's a doctor's words, endemic. And endemic means we're just going to live with it. I think that's the answer.
Did this week's Fed policy meeting signal any meaningful shift in Fed policy, especially regarding the timing of the rate hikes and the amount of the rate hikes this year?
I think what the market learned is that the March-June SEP-D's 4-rate hike plan has been communicated. Powell is behind it. There's a unanimous vote on the FOMC for his view, and there is no movement off that given the Omicron caseloads and case surging. The Fed is not taking that as a change in direction at this point in time.
Q4 earnings season is underway against this economic background that we've discussed. How successful do you think companies are going to be in maintaining decent profit margins, especially the retailers?
I think they're going to do great, Terry. One of the retailers I follow, both Williams-Sonoma and Dick's Sporting Goods, closely the last few days, and they're holding up quite well in this Q4 earnings season. So I think retailers are going to be great.
All right, let's look at a few retail stocks that are on your radar now. There's Home Depot, Lowe's, and AutoZone.
Yeah, let's talk about Home Depot. $360 a share. You got to wonder if that's overpriced. Forward price earnings ratio 23. Price earnings growth rate of 1.9. The basic answer is it's priced, solidly. It might have a 10% or 15% correction, but it's basically good. And you're seeing, very toppy consolidation pattern in the chart. It wasn't a 420. Now it's a 360. So I expect Home Depot is fine now, can trend on in a very modest way. Lowe's, here you got a value score of B, and this is, by the way, a top 7% industry. This was also sold off from 260 to 230, nice 10% down move. And you're looking at price earnings growth rate of 1.4, so you got to like Lowe's at these levels. And let's look at AutoZone. AutoZone has been just on fire. Zacks #1 ranked stock. This stock is $1,900 a share. However, starting 2022 is $2,100 a share. So again, it's pulled back. And the price earnings growth rate is 1.6, which is not out of line. So I like actually this stock because the shorts don't like to tear down a $1,900 share stock. It's really expensive for them. And the forward P at 18, it's not cheap, but it's not offensive, and you've got a nice pullback here to get into AutoZone.
And just to tie things up in light of what we've been discussing at the top of this segment, Are the healthcare stocks risky now?
I think they might be, Terry, because, there's a lot of endemicity that's not going to create healthcare spending. People are going to live with the COVID pandemic more likely than not. And yeah, I think looking for healthcare stocks is going to be in risky, maybe not be the right word, but very selective.
Okay. Our chief equity strategist and economist, John Blank, with his latest economic assessment. And with John, I'm Terry Ruffalo. Here's something for you. Find out how you can get the just released 5 stocks set to double report, where Zacks experts each announce their single favorite pick with potential to gain over 100% in the months ahead. Go to Zacks.com/promo for details.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.